Hello and welcome to another episode of Money Talks with me, 𝗥𝗲𝗃𝗁 from eToro. Thanks so much for joining me again. This week we'll be discussing the big short Michael Burry is buying Google. Should we? So thank you so much for joining me again. The last video was by far my most popular video so far, so I thought I'd do another video on Michael Burry. Next week I'm thinking of doing a video on Alibaba and Charlie Munger again. If you're interested in that, smash the like button and subscribe. I went into this a little bit in the last video, but I wanted to just go over it again very quickly. Michael Burry managed a hedge fund called Scion Capital that between 2000 and 2008 made roughly 500%. In the same time period, the S&P 500 made 3%. So Michael Burry is a very good investor for periods of downturns in the markets or when things are perhaps overvalued. However, if we're investing for a long period of time, presumably I'm going to be investing from my age now, 26, all the way until I'm 80, why shouldn't we just follow investors like Warren Buffett, who have the best track record for the longest period of time? Why shouldn't we just follow their portfolios and their strategies? Buffett is a brilliant investor who deploys a buy and hold strategy. So when it comes to downturns in the market, Buffett doesn't buy positions that are going to do well specifically in that downturn. He just tends to ride the downturn and trust that his companies are good enough to ride that market volatility. However, Michael Burry often offers a contrarian perspective and will bet on businesses that not only survive downturns, but actually do well in those downturns. That's how he managed to make 500% when the S&P only made 3%. He was able to find a way to invest that made money as the market went down. And that's what I find very interesting about Michael Burry, and especially during this time period where the general narrative is the market is heading down. And so it's interesting seeing someone with a contrarian point of view looking at their portfolio and wondering, is that something that I want to buy and hold during this ropey period? However, there's another reason that Michael Burry is perhaps a better investor to look at, generally speaking, than an investor like Warren Buffett. Berkshire Hathaway's fund is $363 billion large. Another thing is Buffett doesn't like to be the primary stakeholder in any of his investments. If you look at most of his biggest stock holdings, Berkshire Hathaway is not the largest shareholder. In Apple, Berkshire Hathaway only has a 5% stake. Their Apple stake actually went up to 7% in 2020 after Apple did a lot of share buybacks. However, Berkshire Hathaway then decided to sell back down to 5% so that they weren't overly invested in Apple. When Warren Buffett thinks of himself as overly invested, he considers he owns too much of the business and he would rather that the shareholders within the business are the most invested and therefore they would take the most care over the business and grow it for him. He doesn't want to do any of the work. However, because he likes to have a 5% stake, and he has a fund of $363 billion, it means there are very few companies for him to invest in. But don't hear it from me. Here's a clip from the man himself explaining why, if he was a smaller investor, he would be looking at very different stocks.
You've repeatedly said that you see many wonderful stock ideas, but can't invest because they're too small. Given that many in the audience today have a lower dollar investment threshold,
do these stocks have names?
Yeah.
Well, the answer to that is that we don't look anymore. We assume that there are a reasonable number of opportunities as you work with smaller amounts of capital, because it's always been true. I mean, it was over the years as I looked at things, clearly you run into companies that are less followed as you get smaller, and there's more chances for inefficiency when you're dealing with something where you can buy $100,000 worth of it in a month rather than 100 million. But that is not because I'm carrying around in my head the names of 25 companies that we could put 100,000 in. And I just don't look at that universe anymore. Sometimes people send me annual reports or get letters from managers, and they say, well, you know, I've got this wonderful thing, and I look I usually know ahead of time, but I mean, I would first look at the size, and if the size isn't right, and it isn't going to be virtually any time, I don't look any further, because there's just no time to be looking at all kinds of smaller opportunities. I do think if you're working with very small amounts of money, that there almost always are some significant inefficiency someplace to find things that I've mentioned to some people. When I started out, I actually went through all of the Moody's manuals and the Standard & Poor's manuals page by page, and you know, it's probably 20,000 pages, but there were a lot of things that popped out, and none of them were in any brokerage report or anything of the sort. They were just plain overlooked, and you could find out about them, but nobody was going to tell you about them.
This is why looking into Berkshire Hathaway's portfolio is not the best place to find value plays for us smaller investors. For us little guys, the best place to go is small cap stocks. So the smaller the business, the more likely there is for a potential for hedge funds and other companies, institutional investors, to misvalue it, and you get a good opportunity to buy in at a low cost to earnings and ride the growth of the business. For me, most of the value plays are somewhere between 100 million and 20 billion. So that's a pretty broad net. However, there are really solid value plays between 20 billion and 100 billion. You're opening yourself to a lot more really good quality companies that are potentially still being undervalued. However, as you go over 100 billion up towards the trillions, the big cap stocks are being monitored by so many investment analysts that it's rare for them to be over or undervalued. Typically, if a stock price got too high in that niche, a bank would sell off some of its stock, because the analysts had done so much research and really gone through with a fine-tooth comb to make sure the price is exactly right. So businesses that are over a 100 billion market cap, it's much, much rarer for you to find something there that is an incredible undervaluation. So again, this is why I find Michael Burry's portfolio so interesting, because there's typically, despite him being quite well known and having a reasonably large fund, there are smaller businesses with a smaller market cap in there that represent potentially deeper value. And you get the Burry seal of approval. He is known for going through stocks with a meticulous comb for very deep value and a proven track record of doing very well during downturns in the market. This leads me on to Google, a very odd stock for Michael Burry to be buying. As I've said, these big tech stocks, analysts are all over them. Their prices are very finely tuned. And so it's pretty hard for them to be misvalued to the point where you make above the S&P 500. For Burry to be buying a blue chip stock from the S&P 500 at the top end from the FANG stocks, I would expect him to believe, generally speaking, that the market has hit rock bottom. However, the reason I'm doing this video and the reason I find it interesting that Michael Burry is buying Google at this present time is he doesn't seem to believe that. He just did a post the other day on June 30th, a month ago, and this is what he said. Adjusted for inflation, 2022 first half S&P 500 down 25 to 26%, and NASDAQ down 34 to 35%. Bitcoin down 64 to 65%. That was multiple compression. Next up, earnings compression. So maybe halfway there. Right, so what he's talking about with multiple compression is the PE, the price to earnings of the stocks, were up very, very high relative to their baseline, 15 PE. So you typically expect a price to earnings of 15. They went way higher than that, and now the multiple has come down. However, the next thing he expects to happen is that companies are going to be earning less. At the minute, the S&P 500 has not had any earning compression. The only thing that has gone down is the price. So Burry clearly thinks that earning compression is coming. The stocks within the S&P 500 are going to earn less in the coming quarters, And so he really doesn't think that the bleeding is over. He expects, if anything, for things to get worse in terms of price of these businesses. So why, when I look at Dataroma, does he have a 10% stake in Google and Meta? But right now, I'm just interested in Google. Meta, I'm just so not interested in it for other reasons. Why is Michael Burry buying Google if he believes earning compression is coming? Well, first things first, for all we know, Michael Burry has already sold out of his Google position. As I said before, all we know is he bought Google at some point in Q1. The reason I think that he's probably still holding Google is because at the end of Q1, Google was around 140. He would not have made very much money based on Google's movements in Q1. He would have had to have bought it right at the bottom, which is possible but unlikely. And he was certainly still holding at the end of Q1. So he's holding it at 141, and since then, the price of Google has steadily gotten lower. So if Burry has closed his position, he's closed it at a loss. So I think Michael Burry will be holding Google in Q2, or at least let's just assume that for this video, and I'll post a comment on the video if we later find out at the next quarter that Michael Burry is holding and I'm completely wrong. So the fact that Michael Burry is still holding Google leads me to believe that he believes it's a good value play. First off, looking at their financials, it is a good value play. It's an incredible business. It grows in revenue 20% every year. So relative to the price of the stock in 2020 and 2021, Google is much better value for earnings. It has an amazing free cash flow. It makes money every single year, and every year it sees gross profit growth, revenue growth, and free cash flow growth. So if you bought £10,000 of this stock, you'd be earning around 549 in operating profits. That's how much cash you'd be getting per year for your £10,000 investment. In 10 years, given their current median growth rate, you could expect that £549 operating profit to grow to £3,393. So you're going from £549 per year to £3,393 per year. Assuming Google at the time has a PE ratio of 10, which is very, very unlikely. Right now, the PE ratio is 20, and that's at a discount. But assuming as a PE ratio of 10, you should now be able to sell the stock relative to earnings for £33,393. However, it's more likely that the PE ratio, especially with this level of consistent compounding growth, would actually be something like 20, in which case you'd be able to sell it for your £10,000 investment for £66,000. And that's assuming Google does no dividends. On top of the beautiful financials of this business, you've also got to value it based on its intrinsic value, its moat, its service, what it provides. Google Search is doing great. Google Play Store is also a very strong moat. Gmail, a brilliant moat. Most people are never going to change their email address. YouTube is very popular, and it's very hard to imagine YouTubers moving platform and people moving to other platforms, creative platforms. Essentially, Google is very deeply trenched in our lives. So from a financial point of view and an intrinsic point of view, Google is very good value right now. But of course it is. Everything is. All stocks are. Confidence in the stock market is at an all-time low. The fear and greed metrics are way into fear, almost into extreme fear. So why has Burry singled out Google specifically of the 11 stocks he is holding in his portfolio? How is it that the best value that he can find is an enormous blue chip stock that surely every analyst in the world has looked at? As the Fed have announced, inflation is on the rise again. And as we all know, that means interest rates will continue to rise. Expectations vary drastically here, but it would be reasonable to assume it's going to rise by at least 1%. This means higher interest rate payments on loans and less money in a consumer's pocket to spend on goods and services. So companies will earn less, and a bigger portion of their earnings will be devoted towards interest payments. If you think central bank interest rates are rising, then you probably can assume that your shares are going to earn less money, unless you think interest rates rising do not affect your stock. This unveils the real reason I believe Michael Burry is buying Google. I also believe that it reveals his Meta purchase. Both Google and Meta have very low debt to equity ratios. Google has a shockingly low debt to equity ratio of 0.08. I was looking at their free cash flow and I saw that they could pay off their entire long-term debt 4 times over, I believe, with 1 year's free cash flow. And as far as consumer spending is concerned, interest rate rises mean consumers have less money. Consumers don't really spend money on Google services. Businesses do. Most of Google works on an auction basis where businesses outbid each other for advertising slots. So Google don't actually have to raise prices. If consumer goods are raising in price, companies will pay more for the advertising slots while competing with one another in order to gain those slots and gain more sales. Won't companies having less money affect how much they spend on Google advertising? Well, maybe, but probably not. Most companies, when consumers start spending less, they start to see a dip in sales. What they'll most likely spend money on is actually advertising. The only risk really to Google's revenue during interest rate hikes is if companies start selling less products for lower prices. But if that's the case, then we're not in an inflationary period. So Google are only at risk if we enter a deflationary environment. I think it's very unlikely that in the next year we're going to see deflation, where companies sell less products at lower prices. Therefore, I see Google as Burry's way of protecting his cash against inflation. While he doesn't believe the bleeding is over in the market, he doesn't want to keep his money in cash. Google represents a way of putting your cash into a business that their earnings will likely grow nicely alongside inflation. As the adage goes, cash is trash. So does that mean you should buy Google? Well, it's hard to say for you. I can't make investment advice on you personally. It's very much to do with what your investment goals are. But for me personally, I don't currently hold any shares in Google, and I'm really happy with all my investments that I've made. I was happy with them when I bought them, mostly in 2021, and I only think they're deeper value now. And I'm very hopeful for my investments in 2022. However, if I had a large pile of cash available to me and I wanted something to put it into over the next 10 years, would I invest that cash in Google? And the answer for me is still no. I'd buy Apple. While I think Google is a brilliant stock and a brilliant investment and potentially the best inflation busting stock, I believe Apple is the mother of creating value. And don't just rely on the fact that consumers are complacent with their products. Every year, I believe Apple actually release great innovations in their goods and services, which I just don't see in other companies. I see companies like Google and Microsoft as having a really good service and mostly just maintaining it. Whereas Apple, I see compound the actual value to the consumer every year. In terms of interest rate rises leading to Apple earning less, if consumer spending drops, will consumers still buy MacBooks and iPhones? Well, honestly, I have absolutely no idea. But I don't think it was penny-pinched consumers who were buying brand new iPhones and brand new MacBooks to begin with. And generally in recession periods, luxury brands tend to do quite well. Louis Vuitton and Lamborghini tend to sell just as many cars and handbags during a recession as they do in the boom periods. And that's because wealthy people tend to remain wealthy and get wealthier. And I certainly think that most people buying new iPhones and new laptops at launch are wealthy people. And so I don't see this recession, certainly this mild recession that we're experiencing now, as having an enormous impact on Apple's earnings. But I could be wrong. So yeah, if I was picking between Google and Apple, my pick would still be Apple. However, I don't actually currently hold any blue chip stocks. I prefer to find deeper value in smaller cap businesses. So that's my blue chip preference. But again, this is not investment advice. None of this is investment advice. This is just my thoughts for entertainment purposes. So please do your own research and like and subscribe. All right, thank you very much, guys. Cheers.